All right, let's stay on the markets here and bring in Michael Jones. He's Caravel Concepts Chairman and CEO. Michael, good to see you on this Friday morning. Listen, you're out warning of a potential market drop. What do you think that catalyst will be?
Well, I think ultimately we've got to recognize that markets are not cheap. They weren't cheap before COVID-19 dinged earnings expectations, and now they're at valuations that we've only seen exceeded during the bubble years of the 1990s and the 1920s. So that means that what's keeping markets at these kind of valuations? It's the Fed. It's the huge injections of liquidity that were necessary to finance the stimulus package for COVID-19. So what will cause the markets to, on a sustainable basis, not the kind of short-term pullbacks like we're seeing in China now or we saw in the US a few weeks ago, but what will cause a sustainable pullback in equity valuations is when the Fed turns off the taps. And frankly, we don't see that for quite some time.
Michael, what do you think about bank stocks? We heard from a lot of them this week in terms of their earnings. We saw that a number of the big banks have set aside billions for potential loan losses. And interest rates are as low as they are. We know that that's usually a bad sign for the banks. What are you doing with financials right now?
So I think financials create an opportunity for some swaps, because there's no question that there are some significant headwinds that are facing the financial industry and banking in particular. And you mentioned one of the biggest, which is interest rates at zero. However, if you look at bank stocks down 30%, REITs are only down 15%. Now, both of them have had their business models severely challenged by COVID-19. But unlike the REITs, the banks are already taking significant action on writing down assets, charging off loans. None of that's happened in the REIT sector yet. And banks have an opportunity to really cut costs, because the revolution in Zoom and Google Hangouts and all the technologies that allow people to work from home, allow people to transact business from home, that means that banks can cut a lot of real estate out of their costs. That means they have some tailwinds from COVID-19 that REITs don't have. As a matter of fact, the tailwinds for the banks are headwinds for the REITs. So we think they're both risky, but if you got to be in it, be in the one that's best valued and has the best catalyst for upside.
Yeah, it's interesting you mentioned the REITs. We had Daryl Cronk on from Wells Fargo in the previous hour, and he was pretty bearish on REITs. What do you do if they're part of your portfolio right now?
I think you get out, and there are opportunities like going into banks where you can take, obviously no one likes to sell something that's been taken out and shot the way that REITs have. But if you can swap into sectors that have been beaten down even more, like banks, also there's an opportunity, in our opinion, in emerging market equities, where particularly the really commodity-centric emerging market sectors. The commodity markets, just like equities, have been driven higher by all that liquidity that the Fed has been pumping into the markets. That means that the equities should have responded as well. They haven't. So there's a potential catch-up trade in commodity-centric emerging market equities, a swap out of REITs into that, a swap out of REITs into banks. You're selling cheap, but you're buying even cheaper.
Michael, make the case to stay long into stocks, into what will be a very contentious presidential election cycle.
Yeah, you bring up a really good point. But in my opinion, the Washington in between now and the election is going to have very little choice but to do another big stimulus package. We've seen the weekly jobless claims stagnate at 1 million per month. Or per week, excuse me. We've seen, there's a lot of news that appears to be that we had a nice bounce and it's really losing momentum. We've got about 30% of renters afraid they're not going to be able to make their rent payment, 15% of homeowners. Another stimulus package is going to be required. How are we going to finance it? The Fed's going to have to print trillions more. That money's going to be injected into financial markets. Even though it looks more likely that Biden could be our next president and corporate taxes go up, that wave of liquidity has been more important than economic fundamentals thus far, and we think it'll be more important between now and the election too.
What's your take on the FAANG stocks, which have just been going bonkers, right? I mean, we're seeing Netflix pulling back today because I guess their outlook wasn't as rosy. You can't add 10 million subscribers every quarter. Sorry, Netflix. But what's your take on the FAANGs? Is it just too frothy for your taste right now?
I wouldn't be adding money there, and I would have a really good stop loss discipline that would have me, slowly take money out. The reality though is that when you are in a liquidity driven money printing market like we are right now, the things that tend to do best are the momentum stocks that have already done best. That's where investors feel most comfortable pouring in your money. So even though their valuations make me uncomfortable, it's hard to imagine that earnings can actually validate, particularly for those like Netflix that are just, or as much as I love Tesla, those kind of valuations are really hard to sustain and to validate with actual earnings growth. As much as it makes me uncomfortable, when liquidity is going to be poured into the market, it's going to go into those momentum names. And if you sell them too early, you're going to regret it.
All right, let's leave it there. Michael Jones, Caravel Concepts Chairman and CEO. Good to see you. Have a good weekend.